Okay, we're going to cover the details on balance sheets, which is presented in Chapter 2. The accounting equation, as you should know by now, is how we process information. So we have our assets, and they equal our liabilities and our owner's equity. What it essentially means is our assets are all the things that we control. Our liabilities is how much we actually owe to external parties, which is what we've funded our assets with. So for instance, if I've purchased a car and it's worth $20,000, well then my assets are $20,000. But if I had to borrow $16,000, for instance, to help me fund the car, I would have a liability of $16,000 and my owner's equity would be $4,000. Therefore, we could say our assets consist of what we owe and then the portion of it that we actually own. What is an asset then? Assets are resources controlled by the entity as a result of past transactions from which a future economic benefit is expected to flow to the entity. So the purchase of a car, if I'm a salesperson or I'll need the car in some capacity to do my job, so it's controlled by the entity. I might have a $20,000 car with a $16,000 liability, but essentially it's mine to use. It's a result of a past transaction. I've got paperwork which proves the purchase of that car, from which a future economic benefit is expected to flow to the entity. So the future economic benefit is that I can then reach my sales target by going out of the business and using my car to circulate. So that's actually the economic benefit. Having the car doesn't actually mean I make a sale, but I'm unable to do my job if I don't have it. Okay, so liabilities are present obligations of the entity arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefits. So it's a present obligation. I can't say I'm going to borrow, therefore I have a liability. It doesn't work like that. It has to result from a past event, so I must already have in my possession from the point that I've borrowed the money. That is the point that the liability is raised. So the settlement of which is expected to result in an outflow of resources. I have to pay it back. It hasn't just been given to me, but it does embody economic benefits. Because I borrowed that money and I have that liability, I therefore was able to purchase the asset of the car and I'm able to do my job. So it must have a purpose for the business. So owner's equity then is the residual interest in the assets of the entity after the deduction of its liabilities. What I say is your asset, your owner's equity is if you imagine you've got your asset, which is your car for $20,000. Once you satisfy your liabilities, so once I've paid the $16,000 that I owe, the portion that I can walk away with is $4,000. So that's my equity, that's my ownership of that car. So the accounting equation must always balance. If it doesn't balance, then you've done it wrong and there's an issue. The balance sheet is an accounting report that details the business's assets, liabilities and owner's equity at a particular point in time. It's a reflection of the firm's accounting equation. So it lists all of those three areas and every transaction affects at least two areas and must create a balanced equation still. So assets can be classified as current if they're expected to provide an economic benefit in the next 12 months. The types of assets which are current assets are debtors. For instance, if we sell our goods on credit, we don't want to wait beyond 12 months, certainly, before our customers have to pay us. We expect that we will receive that in the short term. An asset that is non-current provides an economic benefit for more than 12 months. So while we raise the debtor at the point of a credit sale and we're expected to receive that back, usually within 30 days, otherwise there's a bit of an issue, so that asset is satisfied within a short period of time. A long-term asset would be like the car. We'd expect to have a car for longer than 12 months. Otherwise, everyone knows you lose money on cars. It doesn't maintain its value. So a non-current asset, under current assets, we would have our bank, because our bank is constantly changing. Things like short-term loans, we would have debtors. In our non-current assets, we would have things like cars, buildings, machinery and equipment, anything that is going to help us earn money over a period longer than 12 months. So liabilities are classified as current if it's expected that they will be settled in the next 12 months. So a current liability is a creditor. So a liability is raised when we make a credit purchase. We have got all the elements of a liability. So we've got a current obligation. The minute we walk out, we know we have to pay for the goods back. It's a past transaction. It's going to provide an economic benefit to the business, but it's also going to result in an economic outflow. So the economic benefit is that we have produce that we can actually sell in the short term before we've had to pay for it. And the economic outflow is when we eventually pay for that bill. So they're in 12 months. If we take longer than 12 months, definitely, we will have a bad credit relationship with our suppliers, and they're likely to shut off our supply. So we need to keep current liabilities moving. It's bad for business if you don't. Liabilities that will be settled in longer than 12 months are classified as a non-current liability. So if the business takes out a loan for the car, you'd usually get 3 or 5 years, one of those sorts of periods of time to pay it back. That's a non-current liability. Mortgages, so if you bought a building or something like that for the business, you would usually have a mortgage over the building, and it would certainly be longer than 12 months. Now the thing with liabilities though is that they can actually be non-current and current. You'll see this and they do it to try to confuse you, where exactly the same item will be listed in both current and non-current. Obviously whatever we have to pay in the next 12 months is our current liability, and the remainder of that is non-current. So with my example of a $16,000 loan, just say I took that out over 4 years. So the first time it would appear in the balance sheet, I would have $4,000 in my current liabilities, and I would have $12,000 in my non-current liabilities. At the end of that first year, when I've made all my payments to equal the $4,000, my current liability for the next 12 months is still $4,000, but my non-current liability, the portion that won't be satisfied until the following financial year, would be $8,000. So you reduce at the end of every financial year. You actually reduce what is owed in the non-current, but the current liability should stay the same. If you're confused by this, please ask me to explain again. So double entry accounting is a system that records two effects in the accounting equation as a result of each transaction. As I've said, in the balance sheet it must always balance, but there will never be anything done in isolation. Otherwise it would create an imbalance in that equation. The rules of double entry accounting. The first is, every transaction will affect at least two items in the accounting equation. So that's a double entry. The second is, after recording these changes, the accounting equation must still balance. Sometimes people get a bit confused when the two events, or the transaction that affects two items, can both occur on exactly the same side of the equation. So for instance, if I receive money from a debtor, so my bank account is a current asset, my debtors are also a current asset. By receiving money from my debtor, I'm reducing my debtor and I'm increasing my bank. They're both on my asset side. So it's a transfer from one to the other. It will still maintain balance. Once again, please ask me for further assistance and I can confirm this for you.